Welcome back. Now, the luxury market is taking strain. This has largely been due to the Chinese market, where there's been a slowdown in consumer spending on the back of a downbeat economic growth, causing the valuations of iconic premium brands to plummet, as no company, regardless of its prestige or exclusivity, remains immune to the downturn. And joining me now to share analysis in that market is fund manager at Anchor Capital, Peter Little. Thank you so much for your time, Peter. Now, it's quite surprising to see this narrative of the luxury market being under strain. Is it actually under strain, or is it just not used to the kind of lower, subdued numbers that we have currently been seeing for the last maybe year and a half, 2 years or so?
I think it's a combination of things. So I think we have seen some extraordinary spending on luxury over the course of sort of COVID, when people stopped spending on experiences and they could only spend on goods. So there was a bit of a kind of probably unreasonably high base set during that post-COVID period. Maybe expectations were a little too high, and they need to come get more in line with reality now. We've also got, as you said, China has got all sorts of problems with consumer confidence going on there, and they certainly haven't bounced back from their COVID unlock like we saw in most of the rest of the world. So you've got China struggling. They were a big component of luxury growth going into the COVID unlock. You've got this high base of COVID spending sort of unwinding itself. But I think what we've seen is that the more, I guess you would call it, aspirational luxury brands have struggled a lot more than the sort of very high-end luxury brands. And going into this results season, some of the early reporting companies, things like perhaps Swatch or even Burberry, which are more exposed to those aspirational luxury brands, those had pretty tough results. But things like Hermes and certainly the sort of Cartier, or the very high-end jewelry part of Richemont, those things seem to have held up a whole lot better.
So actually what I'm getting from you at this point is that some animals are more equal than others, and maybe those that are struggling more are maybe the ones that have kind of shifted their focus more to the high-end markets rather than the ones that have always appealed to the high end of the market.
Yeah, I think all of these companies have, most of these companies have a mix of goods, either the really high-end stuff, or some more of the aspirational stuff. I think something like a Hermes is pretty much predominantly ultra luxury. So they have a couple of handbags that you have to wait about a year to buy one of those. You get invited to take advantage of that. So I think companies like that, company like Ferrari, where there's 2-year waiting lists, I think those purchases are still holding up pretty well, and those guys have pretty good pricing power. Hermes, I think, put through 9% sales increases at the beginning of the year. The companies that have more exposure to the sort of aspirational brands, I think they used a lot of pricing power during COVID, when there was huge demand, and also there was some inflation coming through, so they could use that as an excuse. Those guys, the pricing power has definitely come off. I think it's easier to put those purchases on hold than I can imagine if you've been waiting 2 years for your Ferrari, you probably just go ahead and buy it anyway.
I mean, Peter, I'm still waiting for my invite to come from Hermes. But just zooming into the Chinese consumer, because as much as the economic growth numbers have been coming out less than expected, I mean, in South Africa, we can only dream of getting those growth numbers in our economy. Do you think the Chinese consumer is actually, under pressure, or they're just kind of hoarding their money in the face of economic uncertainty? Because it was also quite interesting to see LVMH, when they came out with their numbers, saying that the high sales that they got in Japan were actually boosted by Chinese travelers.
Yeah, so I think there's a few questions in there. So the Japan sales are quite an interesting one, and all of the companies, Richemont, Hermes, most of them had really good numbers out of Japan, and that seems to be largely a function of tourism and a weak yen. So the relative affordability in US dollars of yen purchases was much easier. So you saw certainly the high-end travelers finding it more affordable to travel to Japan, and Japan is obviously a big destination for high-end Chinese luxury shoppers. So you had a bit of that shift happening. But I think in terms of where the Chinese consumer is, the economy's been propped up for probably the last year or two by the industrial part of the economy. The consumer hasn't really come back, and I think a lot of that is just conservatism of those consumers. So they've always had a particularly high savings rate, like around a third of disposable income gets saved in China, and so they kind of tend to skew towards conservative in the face of an environment that's not particularly rampant. But I think also that wealth effect. So Chinese consumers have invested a lot of their savings into the property market in some shape or form. And that's obviously been struggling, and we've seen prices coming down in Chinese property for the better part of 2 or 3 years now. We're still waiting for that to bottom out. And I think while that kind of weighs on the consumer in China, they're going to struggle to go out and spend. So it's really a confidence problem that we're having there as much as an economic slowdown.
All right. Well, yeah, it's quite interesting to see, as much as maybe some, luxury counters are better off than others. Definitely a low tide does sink all boats. Just as we wrap up the conversation there, Peter, the luxury stocks have seemed, defensive for a while. Has their defensiveness been put into question, or are you pegging it as a case of cyclicality?
So I think some of it's a cyclicality, and certainly among the more the companies skewed to more aspirational purchases, and I would say that's kind of a Burberry, Swatch. Those kind of companies are going to tend to be much more cyclical. But even the really high-end ones, I think they've set a really high base. I think they're not going to grow at the sort of 15-20% rate that we're used to, but they still are fairly defensive. These companies, like Richemont's main jewelry business has a 40% profit margin. Hermes is in the 40s. Louis Vuitton's the sort of soft luxury division there is a 40% operating margin, and they've managed to defend those even as sales have slowed. So I think these are still kind of solid companies. I don't think they're immune to economic slowdowns, but I think investors certainly have to kind of be skewed towards the higher end of that luxury spending chain for this type of environment.
All right. Well, thank you so much for that insightful conversation, Peter. Really, really appreciate it. That was Peter Little from Anchor Capital.